The Subcommittee on Housing and Insurance will come to order. Today's hearing is entitled Sustainable Housing Finance, Part 3. We've already had 2 hearings. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Without objection, members of the full committee who are not members of this subcommittee may participate in today's hearing for the purpose of making an opening statement and questioning our witnesses. The chair now recognizes himself for 3 minutes. I first want to thank our panel, our distinguished panel, for coming in today and offering their insights into housing finance. We've already heard from stakeholders that represent several aspects of the housing finance system. We've heard from those who finance purchases of homes, those who build homes, and those who help sellers and buyers meet for that buyer's slice of the American dream. And before us, we have those who have done extensive work in this space, have policy ideas, probably have some recommendations for the must-dos and must-don'ts for this committee, and I look forward to all of your testimony as you advise our committee. But for us, we recognize that the home purchase is probably one of the largest, biggest financial decisions and most important decisions that a person makes, probably besides, what ring you buy and who you decide to marry. This is the biggest decision that you'll make in your financial life. And making sure that we have a system that actually works for all Americans is incredibly important, because we've seen when things go wrong back in 2008, it doesn't just only impact those who purchased a home, it wreaks havoc through the whole economy. People in the industries that involve home purchases and home sales, they get ravaged. We've heard from many of those sectors where many of their colleagues and friends have lost their jobs. We've seen what it does to an economy as a whole. But what we're focused on is what it does to actual home buyers, people who purchased homes that couldn't afford them, how that devastated their financial future, crushed their families. We don't want that to happen again. And make no mistake that we're, almost 10 years on from the crisis. Reforming housing finance is not easy. If we thought tax reform was tough, as we're seeing right now play out in the House, housing finance, I think, is equally as challenging. And I think after the crisis, that there has been no reform in this space is unacceptable. I think we have an opportunity to work across party lines to get an American solution to housing finance. We want to make sure we bring in more private capital. We want to bring in more market discipline. We want to make sure people can still get a mortgage that they can afford. Some might argue that should be a 10-year mortgage. Some are going to argue for a 30-year mortgage. What we want to do is have a system that works for homeowners to get their slice of the American dream, the American experience, which is home ownership. So as we look to all of you, I don't know if we want to classify you as think tank world, but those of you who have worked on policy for a very long time, to give us your insight into the opportunity that presents itself to us today, and again, the advice that you have on how we can make this system work better for the American family. Now, with that, my time has expired. I now recognize the gentleman from Missouri, the ranking member, Mr. Cleaver, for 5 minutes.
Thank you. Excuse me. Thank you, Mr. Chairman. Let me thank all of you for being here today. This is our 3rd in a series of housing finance reform hearings, which I hope you and others realize that because we are going through the 3rd hearing that we are serious about trying to do something that would keep our mortgage financing system functioning at a high level, or higher than it is now. And so over the last few weeks, we've had the opportunity to hear numerous stakeholders regarding their suggestions and proposals for housing finance reform. At these previous hearings, there has been a general consensus that housing finance reform must preserve the 30-year fixed mortgage by including explicit government guarantee. And I believe that this is an essential component of our conversation. As I've mentioned in the past, housing affordability must also remain at the forefront of this discussion. Homeownership rates have been in decline, especially among minority populations, where families have yet to recover from the financial crisis. The path towards GSE reform must include a very strong plan to make homeownership options more available for qualified borrowers and to address the rental affordability crises. Our discussion on housing finance reform should not take place in a vacuum. Currently, the Ways and Means Committee has been marking up the tax plan put forth by the majority that would make changes to the mortgage interest deduction. Specifically, that bill would cap deductions for mortgages on new homes over $500,000, which is an issue we'll get into a little later. But a number of groups have already raised concerns that this change could have a detrimental impact not only on the housing market, but on the middle class. Home ownership is one of our most important tools for households to accrue wealth, and we should be concerned with proposals that would make this more difficult. And so, as our witnesses today, you may have a variety of proposals that can solve this problem today. We can solve it before we have the recess with the members of the Housing Intelligentsia here. There's no question in my mind that you have the solution. We want you to give it to us before noon. Thank you, Mr. Chairman. I yield back.
The gentleman yields back. The chair now recognizes the vice chair of this committee, the gentleman from Florida, Mr. Ross, for 2 minutes.
Thank you, Chairman, and I thank the witnesses again for being here. The federal government's involvement in housing finance is predicated on the idea that it is not only helpful, but it is also necessary. Take a working class family, folks who are scraping by with a modest income. They're deciding that it would be best to purchase a home rather than to continue to pay rent. How are we helping that family? Reasonable people will disagree, but what's most striking to me is that we don't ask a different question. Is it possible that we are hurting that family? Let's recognize that a family may not be able to afford a home. The prices may be too high, the family's income may not rise with those prices. So the federal government says, don't worry, we'll make you a loan, this will be easy. But we already know that the family can't afford the home. That loan isn't a loan, it's an albatross, it's a moral hazard. We're inducing them to take on a risk that is unsustainable. Yet time and again we do it. Why? Because we are told we are trying to broaden access to home ownership and to achieve wealth accumulation for low and moderate income homeowners. That was the argument made during the 3 decades between 1964 and 1995, during which home ownership remained relatively static despite government intervention. Perhaps we just need to try harder. Actually, we did. The following 10 years saw an aggressive increase in the federal government's effort to support home ownership for low and moderate income families. We placed mandates on the GSEs, first requiring that 30% of all mortgages they acquired be ones made to borrowers below median income. From 1996 on, we continued to increase the artificial ratio until 2008, it reached 56%. And for a brief moment, home ownership reached new heights of 70%. Then came the crash, and now we're at 63.9%. And for those at home keeping score, that's just under where we started when we kicked off this project of increasing taxpayer exposure to risky lending. With little to show for it, this project has taken on enormous costs, not just to taxpayers, but through bailouts. For that family I mentioned earlier, the system has raised prices and reduced affordability of homes. The entire point was to help that family purchase a home. We've harmed it. The entire point was to help families keep their homes. I'm afraid that the current system makes that even harder. Let's find a better way. Thank you, and I yield back.
The gentleman yields back. The chair now recognizes the gentleman from California, Mr. Sherman, for 2 minutes.
As I think the other hearings have established, we need a government agency to provide the guarantee if we're going to have 30-year fixed-rate mortgages available to regular working families in the United States. We had a bad program in, about a decade ago where we had entities that had an implicit federal guarantee, but were private companies seeking private profit. Socialize the risk, privatize the profit. We have now a much better system where we basically have government entities, and these government entities are not losing money for the federal government, they are in fact making money for the federal government. We're also dealing with the tax cut. Up at the board we have the, behind the witnesses, the total national debt. That clock will be going much more quickly if we pass $1.5 billion in tax cuts. I should point out that that will certainly make it that this tax bill will certainly make it more difficult for Fannie and Freddie, because as I think our witnesses have written, this is going to adversely affect home prices, particularly in high-cost areas where homes can sell for $500,000, $600,000, $700,000. In addition, we're talking about a larger national debt, which will cause the Fed to give us higher interest rates, again, making it tougher for Fannie and Freddie and the home market in general. So I realize that the jurisdiction of this committee is on housing finance, but our purpose is to make sure that homes are affordable on the one hand, and that people who have their nest egg invested in their homes do not see that wiped out on the other. And the tax bill, as well as some of the issues before us, pose real risks to that average homeowner and that average home buyer. I yield back.
The gentleman yields back. We now welcome and recognize our panel of witnesses. First, we have Peter Wallison, a Senior Fellow and Arthur F. Burns Fellow in Financial Policy at the American Enterprise Institute. We next have Dr. Mark Zandi, Chief Economist at Moody Analytics. Third witness, Dr. Lee, is Principal of Cardiff Consulting Services. Next, we have Ms. McCargo, Co-Director of Housing Finance Policy Center for the Urban Institute. And finally, we have Mr. Ted Tozer, I apologize, Senior Fellow of the Center for Financial Markets at the Milken Institute. In a moment, the witnesses will be recognized for 5 minutes to give an oral presentation of their written testimony. Without objection, the witnesses' written statements will be made part of the record following their oral remarks. Once the witnesses have finished presenting their testimony, each member of the subcommittee will have 5 minutes within which to ask the panel questions. On your table, most of you all know this, but you have 3 lights. Green light means go, yellow light means you have a minute left, and the red light means that your time is up. The microphones are sensitive, so please speak directly into them. And with that, Mr. Wallison, you are now recognized for 5 minutes.
Thanks very much, Mr. Chairman, Chairman Duffy, and Ranking Member Cleaver. Thank you for this opportunity to testify on housing policy reform. My view, as detailed in my written testimony, is that the best U.S. housing policy in the future would eliminate the government role in housing finance, beginning with the GSEs. I take this position for the following reasons. First, the GSEs do not reduce interest rates. Our analysis at AEI shows that since 2014, after controlling for mortgage interest characteristics, the private market, primarily banks, has been offering mortgages with lower interest rates than the GSEs. In addition, the private sector mortgages we compared to GS mortgages were 30-year fixed-rate loans, which are readily available from private sector lenders without a government guarantee. Many members of Congress have been told for years that there would be no 30-year fixed-rate mortgages without government backing, but our research shows that this is false. Second, the GSE's lending policies increase housing prices, making homes less affordable. Mortgage interest standards, not interest rates, are the key to housing prices. Today, the GSEs are willing to acquire mortgages with 3% down payments or less, so the buyer will be buying 97% of the price of the home. What this really means is that the buyer reaches for the most expensive house that the loan puts within reach. This exerts strong upward pressure on home prices, which are now, again, rising faster than wages. This particularly hurts first-time home buyers. Third, GSEs do very little to help low and moderate income families buy homes. I think everyone would agree that if any families need help to buy homes, it would be families taking out loans for less than $250,000. Half of these households have estimated income below $66,000, which is 120% of the U.S. median income. Yet, only 11% of the GSE's activities are helping these families buy homes. An additional 27% of GSE activities are home purchase loans greater than $250,000, with a median borrower income of $122,000. These loans could easily be made by the private sector, especially when the GSEs, as noted above, do not reduce interest rates. The rest of the GSE's activities, about 60%, is refinancing mortgages, financing second homes, and financing investor purchases of houses for rental. None of this contributes to home ownership by families that want to buy a first home. Fourth, the GSEs cost the Treasury billions of dollars each year. The GSEs and their supporters often argue that because many investors, including foreign central banks, are required to invest only in sovereign-guaranteed debt, the GSEs have a ready market around the world. However, because the GSE's debt pays slightly more than Treasury securities, it is often a substitute for Treasury securities. This means that when the GSEs sell debt abroad, or even in the U.S., they are reducing the demand for U.S. Treasuries and thus increasing what Treasury has to pay. We estimate these costs at about $17 to $29 billion a year. For the reasons I've described, government housing policies, and particularly the GSEs, have been a failure. They are not reducing interest rates on mortgages. They are not necessary for 30-year fixed-rate mortgages. They are increasing the prices of homes, especially for first-time buyers. And they do not increase home ownership. In 1964, as Mr. Ross mentioned, the home ownership rate in the United States was 64%. It was still 64% in 1994. After HUD's aggressive increase in the affordable housing goals using the GSEs, the home ownership rate reached almost 70% in 2004. Then came the crash, and the home ownership rate today is 64%. The housing finance market, home owners, home buyers, and the Treasury would be better off without the GSEs. The private sector is fully capable of handling mortgage finance, just as it currently handles the financing of automobiles, credit cards, and other assets through a combination of banks and asset-backed securitization. Thanks again for this opportunity to testify.
Thank you, Mr. Wilson. Dr. Zandi, you are now recognized for 5 minutes.
Thank you, Chairman Duffy, Ranking Member Cleaver, the rest of the committee. Thanks for the opportunity, and thank you for engaging in this conversation. I think, as you say, it's a very important one. It's been much too long to address this particular issue. In addition to being the chief economist of Moody's Analytics, you should know I'm also on the board of directors of MGIC, a private mortgage insurer, and I'm also on the board of a CDFI based in Philadelphia, and we do a lot of affordable housing through the CDFI, one of the largest in the country. Let me make 3 quick points, maybe 2. First, the future housing finance system that replaces the GSEs, in my view, must have an explicit, catastrophic government guarantee that is fully paid for by borrowers. I think this is a necessary ingredient for any future housing finance system. An explicit guarantee stands in contrast to the implicit guarantee that Fannie Mae and Freddie Mac enjoyed prior to the crisis, is important. Catastrophic in that the government should not step into the system unless we face scenarios that are darker than the Great Recession, the 2008-2009 financial crisis. And I do think it needs to be paid for by the borrowers in this part of the system that enjoy that government guarantee. And I do think there's been a lot of work done, including some of my own, that shows we can do this and still maintain current mortgage rates. In my view, without this explicit catastrophic government guarantee that's paid for, mortgage rates would be measurably higher than they are today. Some of the work I did with regard to the PATH Act that was before this committee a few years ago showed that mortgage rates for the typical borrower would be as high as 100 basis points higher today than they would have been otherwise. And that's for the typical borrower. For those that are less creditworthy, towards the edge of the credit box, the impact would be on mortgage rates would be measurably higher, and thus the ability of the system to provide affordable loans to those borrowers would be significantly impaired. They would not be able to get loans. They would not be able to become homeowners. So point number 1, we need that explicit catastrophic government guarantee that is paid for. Point number two, there's been a lot of work done in thinking about how we should reform the system. I've thought about all of them. I've gone down all of the different paths. And in my view, the most viable proposal for reform, both from an economic perspective and given the current political environment, if we want to get this done anytime soon, is a multiple guarantor system. So what that means is that Fannie Mae and Freddie Mac would only be reprivatized until the system was able to maintain a number of several other viable guarantors, similar guarantors that meet the same requirements as Fannie Mae and future Fannie Mae and Freddie Mac would be required to hold as well. This will ensure that the future system will promote competition. I think competition is key in the secondary market to make sure that borrowers get the best mortgage rates, and perhaps more importantly, we get innovation in the provision of mortgage credit, because the demographics of the country are changing and the way people will access credit will change, and we need a system that will be able to keep up with that. This multiple guarantor system will also ensure that we do away with too big to fail. Obviously, the pre-crisis system with the duopoly, Fannie and Freddie, they were too big to fail unless the government had to step in, and the resulting costs were enormous. With multiple guarantors on equal footing competing in the marketplace, we'll do away with too big to fail in that particular problem. All of this can be done and ensure that there's plenty of private capital in front of taxpayers, and we meet all of the access that we need for small lenders and for underserved communities, and we can maintain a current mortgage rate. So it's very doable, and even if you don't think that the multiple guarantor path is the right path, again, I think it's laudable that you're thinking about this. This is the time to do it. Do it now when the economy is in good shape, the housing market and house prices are rising, and so that we don't have to do this in the next crisis. Thank you.
Thank you, Dr. Lee. You are now recognized for 5 minutes.
Chairman Duffy, Ranking Member Cleaver, and members of the subcommittee, thank you for the opportunity to be here today. I have an extensive background both in U.S. housing finance and mortgage markets abroad, having worked in more than 30 countries over the last 25 years. In addressing the subcommittee today, I've been asked to discuss how housing is financed in other major developed markets. My remarks will focus on 5 countries whose housing finance systems differ significantly from that of the U.S.: Australia, Canada, Denmark, Germany, and the United Kingdom. I will cover what is common amongst those systems, what is different, and what the U.S. might learn from how housing is financed in other countries. I begin with what is common. Current U.S. rates for adjustable and fixed-rate mortgages are comparable to mortgage rates in other countries. Recent house price increases are similar to those in the U.S. A third commonality is home ownership rates, which range between 62% and 67%, with the exception of Germany at 52%. There are significant differences in the size of country markets relative to the size of their economy. The mortgage markets of all the comparable countries, save for Germany, are larger than the U.S., with mortgage debt to GDP ranging between 65% and 94%. The U.S. has been as high as 73% in 2009, but is only 55% today, reflecting the effects of the mortgage crisis. Notably, of these countries, only Denmark and the U.S. have a mortgage interest tax deduction. There are significant differences across countries as to which entities provide mortgage loans. In Europe, mortgage lenders must be regulated banks. Banks originate and hold the vast majority of mortgages in Australia, Canada, and the UK. This contrasts with the US, where banks originate only 40% of mortgage loans, and most debt is held or backed by government entities. There are significant differences in the predominant mortgage instruments across countries. The U.S. is unique in the dominance of mortgages with rates that are fixed over the entire term of the loan and where the loan is prepayable without penalty. Denmark uses this instrument with one significant difference. While both Danish and U.S. mortgages allow prepayment at par if rates fall, in Denmark, borrowers can repurchase the bond that funds their loan at a discount if rates rise. In this way, the borrower can deleverage as rates rise, reducing the likelihood of negative equity. The standard product in Canada, Germany, and many European countries is a short to medium-term fixed-rate mortgage. The rate is fixed for a 1 to 10-year period over a longer amortization, after which the rate is reset at current market interest rates. The borrower can select the same or a different fixed-rate term at reset, which allows them some protection against potential interest rate shock. Australia and the UK are primarily short-term variable rate markets. Policymakers in both countries credit the predominance of variable rate loans for cushioning the impact of global recession. Mortgage rates fell close to zero when base rates were lowered. Borrower payments fell without having to refinance, unlike in the US, where many borrowers were unable to lower their mortgage rates and payment due to limited or negative equity. Mortgage funding is also different across countries. The US is unusual in the dominance of securitization. 65% of mortgage debt outstanding is securitized in the US. This reflects two factors: the domination of the fixed-rate mortgage and the presence of government-backed entities that guarantee the securities. The only country that comes close to the US is Canada at 31%. The main capital market funding instrument in Europe is covered bonds. These are corporate bank-issued bonds backed by a ring-fenced portfolio of mortgage loans. They represent over $1.7 trillion in outstanding mortgage-covered bonds, covering approximately 25% of European mortgage debt. Mortgage underwriting is usually stricter in most other countries as well. In Europe, the typical down payment requirement is 20%. Canada tightened its underwriting requirements after the crisis. Purchase loans are required to have a minimum 10% down, refinance 20%. Mortgage loans are recourse obligations in all countries surveyed, and default rates have been and are significantly less than the US. So what can the US learn from studying housing finance systems in other countries? There's no ideal housing finance system. Individual arrangements reflect history, market structure, and government policy. No other country's housing finance system evolved with extensive reliance on securitization or GSEs. Lenders are subject to prudential regulation, but none are subject to mission regulation or housing goals. Importantly, there is skin in the game in housing finance systems in most other countries. Banks are subject to domestic and international capital rules and hold considerably more capital than that held by mortgage agencies in the US. In no other country is the 30-year fixed-rate mortgage the dominant instrument. As we learned from the savings and loan crisis, the fixed-rate mortgage is not a suitable product for bank lenders. Rather, it requires capital market financing, which in the US is achieved through the US government guarantees. Guarantees lower the relative cost of the fixed-rate mortgage, sustaining its dominance and that of the entities backing them. The result is the government, and thus taxpayers, backs the majority of mortgages in the US. The experience of other countries shows that high rates of homeownership, stable, well-developed mortgage markets can be achieved with less systemic risk than found in the US. In that respect, the US clearly can learn from international housing finance systems. Thank you for the opportunity to appear today.
Thank you, Dr. Lee. Ms. McCargo, you are recognized for 5 minutes.
Good morning, Chairman Duffy, Ranking Member Cleaver, and members of the committee. Thank you for the opportunity to testify. My name is Elena McCargo, and I'm the co-director of the Housing Finance Policy Center at the Urban Institute. The views I express here today are my own and should not be attributed to the Urban Institute, its trustees, or its funders. In 1968, President Lyndon B. Johnson founded the Urban Institute to help solve the problems that weighed heavily on the hearts and minds of America by bringing sound research, evidence, and perspective that could inform effective policymaking. At the time, the problem was the American city and its people, and the declaration of the war on poverty. Johnson signed the Fair Housing Act into law that same year, making housing discrimination against blacks and other protected groups for renting and owning homes illegal. I mention this history as a reflection for this Congress as you consider the future, as we are facing some of the very same inequities that are plaguing not only our cities, but our suburbs and rural areas all over this country 50 years later. I will focus on the serious issues surrounding the housing finance system and the ways Congress can address those issues with comprehensive reform. Our country has changed, as has its needs. Huge demographic shifts in race, age, income, and education are all significant drivers of what our future housing system needs to contemplate. First, there is a growing wealth gap, and it's hurting low and middle income families. The gap persists both between races and between owners and renters. We know that homeownership creates wealth through equity and asset building, and it continues to be the primary way that many middle-class and working families build wealth and achieve economic stability, especially for families of color. As an example, to emphasize this problem, the overall homeownership rate today for blacks is just below 42%, back to levels we have not seen since the 1960s, before the Fair Housing Act was put in place. Major housing policy changes are needed to address systemic constraints for people of color and avoid dire consequences for the financial security and generational wealth prospects of millions of Americans. Second, we have insufficient affordable housing available for a growing number of diverse households. Over the next decade, there will be as many as 16 million new households formed, and an overwhelming majority of that growth will be non-white. Our housing inventory, rental and owner, is already deficient, continues to age, and is not being built or preserved to keep pace with demand for affordability. Third, consumers have insufficient access to mortgage markets, hampering homeownership opportunity. This issue has its roots in underwriting standards and the lack of willingness for market participants to take on any default risk. Urban Institute's research finds that more than 6.3 million more mortgages would have been made between 2009 and 2015 to credit-worthy borrowers under reasonable lending standards. In the current system, mortgages are only being made to people with pristine credit quality, despite their overall creditworthiness. A systemic view of underwriting systems and credit scoring models should be considered. Our country deserves a housing finance system that serves the people and communities that need investment and that provides access to sustainable and affordable credit. I'm going to highlight 3 critical elements for this reform. To start, consumers must have access to sustainable, affordable mortgages. Long-term fixed-rate products allow access to credit with affordable monthly payments and without the risk of interest rate volatility. This is essential in market stability and gives homeowners the ability to build equity. Ensuring the availability of these mortgages requires the explicit backing of the federal government. Next, taxpayers must be protected. Private capital in the first loss position will protect taxpayers without undermining access to credit for credit-worthy borrowers and access to the secondary market for lenders of all sizes. There must be a mechanism to ensure capital is available throughout the economic cycle to a broad set of financial institutions. And finally, improvements are needed to FHA so that it can work to fulfill its mission. Because FHA provides a critical source of financing to historically underserved renters and homeowners and plays a pivotal role for low-income renters, first-time homebuyers, and for seniors, we should ensure that FHA and Ginnie Mae have clarity and certainty in any housing finance reform. FHA must work in a coordinated and efficient way in the housing finance ecosystem. In particular, FHA needs resources to significantly modernize its technology and operations in order to meet the needs of today's consumer. We have one U.S. housing market, and we should have one housing finance system and a national housing policy that safely and efficiently serves all communities and all demographics and is accessible at all times. Thank you for the opportunity to testify. I look forward to your questions.
Thank you. Mr. Tozer, you are recognized for 5 minutes.
Good morning, Chairman Duffy, Ranking Member Cleaver, and members of the subcommittee. My name is Ted Tozer, and I appreciate the opportunity to testify today on behalf of the Milken Institute Center for Financial Markets, where I'm a senior fellow in the Housing Finance Program. My background gives me a unique look into the question of housing finance reform. Prior to joining the Milken Institute, I spent 7 years running Ginnie Mae as its president. Prior to that, I spent 25 years running capital markets for a top 10 mortgage banker. Any industry could find itself with the complacent status quo leaders. The challenge is when competitive disruptors are not able to break in. This is a situation in the mortgage market. The GSE duopoly of Fannie Mae and Freddie Mac is restricting credit and slowing down innovation. A key choke point is restriction on the type of loans that GSE will allow to be sold into the capital markets. A reformed housing finance system should focus on fostering innovation driven by competition. I'll give you an example to demonstrate the positive impact of competition. When I joined Ginnie Mae in 2010, approximately 70% of the new Ginnie Mae guaranteed MBS were issued by 4 large banks that had put in place credit overlays that prevented many low to moderate income borrowers from obtaining Fannie Mae or FHA financing. The average credit score for an FHA loan was around 720, limiting FHA's ability to be a countercyclical force to support housing. Starting in 2011, smaller lenders instead became issuers themselves. This meant they could bypass the big banks, set their own credit standards within the limits prescribed by FHA. Today, Ginnie Mae has approximately 440 approved issuers, and no issuer has more than a 7% market share of new issuance. The average FHA credit score is about 675, meaning the aim of the program in responsibly expanding access to mortgages. Adding the competition of lenders was key. This goes to the heart of the difference between the various housing finance proposals. Should there be 1, 2, 6, or hundreds of guarantors? I believe the most advantageous approach was put forward by the Milken Institute, that hundreds of guarantors should be allowed. The mortgage industry faces the challenge of changing demographics as minority borrowers become the major home buying group in the future. And lenders need to have the flexibility to create loan programs that meet the needs of these unique communities. The strength of Ginnie Mae's structure is the guarantors have skin in the game, even while the U.S. backs the MBS. That's because the issuer is responsible to advance delinquent payments to MBS owners and use their own funding sources to buy delinquent loans out of pools. Competition also means the firms that do not perform well can fail without hampering the whole housing finance system. This is a huge advantage over the previous or current system centered around the GSEs. During my tenure at Ginnie Mae, every issue we had to shut down was due to the lack of liquidity to make required payments to bondholders, not their exhaustion of capital. The goal of Ginnie Mae was to spread the counterparty risk among hundreds of issuers to enable Ginnie Mae to transfer failed issuers' portfolios to other Ginnie Mae issuers, similar to the way the FDIC transfers deposits and assets from a failed bank to another FDIC-insured bank. A future system must ensure that small lenders and guarantors have equal access to credit enhancers. If not, the potential base of hundreds of issuers will be reduced substantially, and the competition and community-based lending will be minimized. Ginnie Mae must make sure credit enhancement is equally available and credit enhancers are working with issuers to develop customized solutions to support their communities. We need to look at other options that will increase underserved markets' access to housing finance. Having hundreds of guarantors will allow community-based solutions, not solutions that are defined on a national level. We need to build off the gains made by the GSE's affordable national housing mandate at the national level and build an environment where lenders embrace affordable lending, not as a box that has to be checked, but as an economically viable part of their business model. I look forward to your questions.
Thank you, Mr. Tozer. The chair now recognizes himself for 5 minutes. I'm going to cut to the chase on an issue that I know is going to come up today because we're talking about tax. Ms. McCargo, do you have a definition of kind of how much money someone makes to be middle income?
We have a definition. We have standard area median incomes, and it's all depending on what part of the country you live in.
Good. If you make $100,000, you middle income?
You can be middle income at $100,000 in parts of the country.
How about 200,000?
Yes.
300?
I'm not sure. I don't think so.
And if you're making $300,000 a year, can you get $1 million mortgage? Pretty tough, wouldn't it be, to get $1 million mortgage? I would agree with that. And I just want to make this point that when we have a conversation, which I'm off topic, I'm going to get back on topic in a second. When we have folks who say, I don't want tax breaks for the rich, but they want to argue for $1 million mortgage interest deduction, they're not really focused on middle-income Americans, per your point, Ms. Cargo. They're focused on rich Americans. Now, I don't have a problem with mortgage interest deduction at $1 million, but it's interesting how rhetoric and policy all of a sudden clash when a lot of my friends have very rich constituents who they start fighting for in some of these loopholes and write-offs. And I got to make sure my time is running. If you want to give me another full 5 minutes, I guess.
Will the gentleman yield?
If I get all 5 minutes, yeah, I will. Yes, I will yield.
come to my district, I'll show you the middle-class, hardworking Americans whose homes require, sell for many hundreds of thousands of dollars more than
But
another.
$1 million? $1 million.
Unindexed a few years from now, absolutely.
Well, we could talk
Remember,
about
that
index.
million is not indexed. Neither is the $500,000. But yes, even
I'm gonna reclaim my
a
time.
$1 million home with two hardworking, a nurse married to a police officer.
I'm going to reclaim my
is
time
very
because they actually took off a minute. But I just think that's an interesting point that we can't forget in this debate of rhetoric is one thing, but when your constituents start to get hit by loopholes that benefit the wealthy, they start to go away. It's interesting to see people squirm. But I'm not here for that. Mr. Tozer, we're having a conversation about the MBA proposal, DeMarco Bright, Urban Institute. Have you reviewed those plans, and do you have an opinion on what would be the best path forward for this committee?
Yes, I've looked at all of them, and again, from the standpoint, I think the issue comes down to is basically how many guarantors or issues you want to have. I mean, that's really what it comes down to if you compare the MBA and the other programs. I think they're all basically very similar, but it comes back to how many guarantors or issues we should have. And again, like I mentioned in my statement, I think the concept is having as many as possibly can be successful. So more getting back to community lending, I think, is really important, and to be able to respond to market conditions.
Is it important that lenders have some skin in the game?
I think it's really important for the institutions that are being backed up by the government to have skin in the game. I think they should, just so, again, they're aligned with the government and their interests.
I'm interested in the panel's opinion because right now QM has a debt-to-income ratio of 43%, but Fannie and Freddie has bumped their own standard up to a 50% debt-to-income ratio. I'm wondering if, lenders throughout America would be making a lot of loans at a debt-to-income ratio of 50%. Mr. Wallison, do you have an opinion on that? Or if they had some skin in the game, might they go, well, I might want a little different debt-to-income ratio if I actually am the, one of the first dollar losses here? You have to turn your microphone, Mr. Wallison.
Lenders throughout the United States would be making these loans if they can sell them to the government.
But if they had to keep some skin in the game.
If they had to keep the skin in the game, they would not be making those loans.
At 50% debt to income.
50% debt to income. But if they
Why
did
not,
make
Mr.
the loan,
Wallison?
well, one of the reasons they would not be making those loans is that it's exceedingly risky. These loans are exceedingly risky. These are people, by definition, with a DTI of 50% who have a lot of obligations in addition to their mortgage obligations, and though that kind of borrower is someone who has a high risk of failure, especially if housing prices should fall.
I heard a stat that half of Americans are a $400 financial crisis away from being in financially hard times. And it seems like it's this very person who has a debt-to-income ratio of 50% that we're allowing to get in to a home that maybe they should take a little more time. Maybe they should, write their debt or make some more money before they actually get a mortgage, because as Ms. McCargo indicated, you get people who their main investment is their home. And the government is subsidizing or incentivizing people to get mortgages that they probably shouldn't get. And when things go wrong for them, it financially devastates them. Mr. Zandi, I appreciate your testimony. Wow, we had a lot of kind of agreement today. It was great. Of the plans that you've evaluated, which one do you like the best in your viewpoint?
I think the most viable is the multiple guarantor system, which is similar to the MBA proposal. I agree with Mr. Tozer that it's not dissimilar for the DeMarco Bright proposal, but the multiple guarantor system, I think, is just more doable.
Why?
Because you're using the existing infrastructure, the common securitization platform, the risk transfer process, all of the things that the GSEs have been doing since they've been put into conservatorship. So you're leveraging all of the good work that they've done to get private capital into the system and make sure that you can have entry of other guarantors into the system. So I don't think we want to throw that away. I think that's very valuable and useful. And if we go down the DeMarco Bright path, the sort of expanded Ginnie issuer system path, that's just a wholly different system, and you're not using all the good work that we've done. And it'll be very hard to get, to be frank, from a political economy perspective, all of the stakeholders involved here to sign on to that. They just can't get their mind around it. The multiple guarantor system, they can, and you get a lot of the benefits that you want, the competition, the getting rid of too big to fail, a lot of private capital in front of the government guarantee. So I think that's just the most viable approach.
My time has long expired, but I look forward to more lengthy conversations with all of you as we go through this process. The chair now recognizes the ranking member, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Just a point here. The average cost of a home in my state in Missouri is $169,000. The median price of a home here in D.C. is $551,000. And most of the people who live in those homes are not rich. They are struggling. I look at many of our staff members will just rent an apartment with 4 or 5 people living in the apartment together because even the rental rates are very high. But I just mentioned that to speak to the mortgage being capped at $500,000. Mr. Zandy, thank you for being here again. In your opinion, why would the disadvantages of a private GSE system largely outweigh the advantages?
I'm sorry, can you?
Why would the disadvantages of a fully private GSE system largely outweigh the advantages?
So to go to a fully privatized system without a government backstop, without an explicit catastrophic guarantee that's paid by the borrower, that would result in my view, significantly higher borrowing costs for everyone in that part of the system. For the typical borrower, kind of in the middle of the distribution in terms of credit characteristics, the average mortgage rate would rise about 1 percentage point. So instead of 4% today, it would be 5%. For those that have credit characteristics that are not as good as the typical borrower, their rates would be even higher than that. So if you get towards the end of the credit box where the GSEs are able to make a loan or insure a loan, mortgage rates would be so high that these folks couldn't afford to buy a loan, so they would be locked out of the market. So I think that's the most significant disadvantage. Right. And it's almost, I'll make another point, second point. I'm not sure it's even viable, because if you get into the next crisis, think about it. You get into the next Great Recession, the financial system is imploding, and hopefully that's not in our lifetime, but it will be in someone's lifetime. Do we really think the government won't step in? It will. And yes. So let's just recognize that, acknowledge it, and pay for it up front instead of waiting for that to happen and just taking our chances. So let's just be honest here about the reality of this.
Yes, I agree. I was here. Mr. Sherman and I don't want to get into it because I got too much time. Because Mr. Wallison, you had mentioned earlier that in your opinion we could make it without the GSEs. And so if you can answer it briefly, because I want Ms. Cargo to also deal with it. So Mortgage Company A in Kansas City, Missouri, is financing all these mortgages. Aren't they going to be limited if there's no secondary market? I mean, there's just so many mortgages that a local mortgage company could handle. So what aren't they going to face a problem, which eventually falls on the whole population of our city?
No, because there is a private securitization system that will grow up to take those mortgages that the banks do not want to hold in portfolio.
What do you base that on?
The existence of a private mortgage, the private mortgage system that we had, mortgage securitization system that we had before the financial crisis, and the existence today and before the financial crisis of securitization systems for credit cards, for auto loans, and for many other assets. So the private sector is well able to handle all of these things, and there's no reason to have the government involved. And as I said in my testimony, the government causes higher prices. So your constituents, as well as everyone else's constituents here, cannot afford even the entry-level homes because of the way the government is driving up housing prices.
Ms. McCargo.
Thank you, Congressman. The privatization of the GSEs, we've come out of an era when they were operating as both a private and public under a dual mission, and we learned a lesson from that, and that is something that I don't think we want to go back to. You know, having the GSEs available to ensure that there is a guarantee, provide certainty, and protect taxpayers with others and with other private support in a first loss position is a healthy way to sort of move us forward. I think the lack of an explicit guarantee takes away the opportunity for markets to open up, for lenders to participate in small communities, in rural communities in a way that's meaningful. And I think that that's a, you know, if we had a private market that was willing to take all these risks without anything, we would have a much healthier situation right now. No one is making these loans are not being made without some sort of catastrophic loss guarantee from the government, and I think we need to make sure we keep that preserved for any future system.
Time is up.
The gentleman's time has expired. The chair now recognizes the vice chair, Mr. Ross.
Thank you, Chairman. 33 years ago, my wife and I purchased our first home. We did it under FHA, and we put 5% down, and at the time, we also paid what I learned was called PMI, private mortgage insurance. And the reason we had to pay that is because unless we put 20% down and financed 80%, we had to have the guarantee in there just in case of a default. And it led me to believe then that I needed skin in the game, but more importantly, it also to this day shows me that there was capacity in the market from the private sector to take some of that risk. And I guess what we've seen over the last two panels that appeared before you in this topic is that a government backstop is absolutely necessary because apparently the private sector cannot accurately price or set aside reserves for a deep-in-the-tail risk of severe turndown in the housing market. Is that something that each of you agrees with, Mr. Wallace? I mean, are we losing, is the private sector so inept that we can't allow them to have confidence in their pricing in the event we do another crash that we had in 08?
One of the reasons we had the crash in 08, the major reason we had the crash in 08, is that the government had driven up through its policies housing prices beyond the level where they made any economic sense because the government was buying those mortgages. And so, and of course, when we had the crash, the housing prices fell, and a lot of people, especially low-income people, lost their homes.
And to that end, let's assume that back then we had a viable private market of buying these mortgages. Would it not almost self-regulate because it wouldn't take the risk that was being purchased then by the GSEs?
One of the things that we have to understand, and what doesn't seem to be understood here, is that there's a trade-off between underwriting standards and housing prices. And if you reduce, say, down payments to a very low level, you increase the amount of debt that the homeowner takes on. When the homeowner takes on a lot of debt, not only does that homeowner become a riskier credit, but in addition, that drives up housing prices, and so fewer people can afford houses. So in other words, when we reduce underwriting standards, especially down payments, we make it harder for people to enter the home ownership system because housing prices have risen much faster than wages are rising. As a result, we are stuck at 64%. We could have a much more viable and a higher home ownership system in the United States if we allowed prices to go to a level that the private sector would produce, and that would be through using solid underwriting standards, including solid down payments.
Could I answer your question?
Please.
Basically, that's kind of the heart of our proposal, because we look at the fact that there's two sets of investors. There's investors that will invest in credit risk, and investors' interest rate risk.
Right.
And we're looking at, the proposal that Milken is, we'll backstop the investors that want interest rate risk because they need to have a commodity that they can trade to manage their interest rate risk. But our proposal is to let the private sector hold all the credit risk in the form of either the issuers holding the tail risk and the people holding the front. You mentioned PMI.
Right.
I think PMI is the natural in a future state where the PMI companies can take on, not only up to 20% down payment, but maybe let's go to even 70%. And that way the issuers are protected, but the government is simply stepping in to support the interest rate investors the same way the FDIC protects depositors. Right. Like depositors are protected by FDIC. FDIC does not guarantee the loans that are in the bank's portfolio.
And there's enough capacity waiting to do this, isn't there?
And that's exactly how Ginnie Mae works. Ginnie Mae does not guarantee any loans. We guarantee the issuer's ability to handle their bond payments, and that's the heart of the Milken program initiative, is to say that we have hundreds of issuers, just like we have hundreds of banks, and they're able to all get interest rate protection in the capital markets, but the credit risk is held by the private sector.
Congressman,
and Dr. Zanni, I want to go to you.
Just to make clear, Mr. Tozer's proposal, though, has an explicit catastrophic government backstop that's payment. And that's the point. If you want...
but you seem they can offload these credit risks with incentives to the private sector.
They can offload all of the risk except the catastrophic risk. You need a government backstop to take the catastrophic. And if you don't, then mortgage rates will be higher, and long-term fixed-rate loans, 30-year loans, 15-year loans.
How much higher? Are we talking in terms of basis?
For the typical borrower, I'm just going back to the PATH Act. That was the last attempt at this. So let's take that as our benchmark. That would have raised mortgage rates for the typical borrower by almost a full percentage point without that government backstop. Now, of course, there's a lot of other moving parts in PATH, and that could be mitigated. But that's what you're talking about, and that's the person in the middle, right?
But that's the elimination of a taxpayer bailout with that extra point.
That is, you have no government backstop. That's what you're giving up. And then if you did that, then basically you're saying, we don't 30-year fixed rate loans, 15-year fixed rate loans. There'd still be some out there, like there are in other systems across the world, but they'll be a very small piece of the pie.
I see my time's expired. I yield back.
Gentleman's time has expired. The chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Mr. Chairman, you paint a picture of luxury if someone has a mortgage of over $500,000 in California. I welcome you to go to the average home in your home state, knock on the door, say you've got so many bedrooms in that most average home, you are living in luxury. Because I assure you that the average home on the average lot in the state of Wisconsin would cost over $1 million if located within commuting distance of Silicon Valley. Those are the prices, and perhaps we need to organize, we go on Codels to strange and foreign countries. Perhaps we need a Codel California, so that you will see that things are different in my state than they are in yours. As to our housing finance system, we currently have a 30-year fixed rate, non-recourse, prepayable.
Could we go in January or February?
Yes.
Done.
Maybe when the Grammys, the Emmys, we'll talk. It's about time. On foreign affairs, I never thought of a Codel from this committee, but I think it would make sense. We have the 30-year fixed rate, non-recourse, prepayable loan. That's the best deal home buyers have anywhere in the world. And oh, by the way, with a 10% down payment. In so many countries, if you don't have parental help, you can't buy a home. You can't get the down payment. The tradition in Iceland is that you work for many, many years on ships in order to get the down payment. And it is so I think we've got a system that is good for home buyers. It's also been profitable over the last few years for the government. It is not true that back in the 60s we didn't have government involvement. What we had then was savings and loan institutions with enormously high leverage, all supported by the government. That provided good mortgages until it collapsed at government cost. Ms. McCargo, you're absolutely right. We need to build more homes. Mr. Zandy, a lot of people in my district, which the chairman will be visiting this winter.
Can I come too?
Absolutely. They've saved all their lives. They've put their kids through school, and what they have is about a 20% equity in a home that's worth between $500,000 and $1 million. So let's say we limit the home mortgage deduction to $500,000. We limit the property tax deduction to $10,000, and they go to sell their home. The buyer's going to know that those limits exist. And oh, by the way, the buyer's going to know that those limits aren't indexed. So 10, 20 years from now, when they go to sell their home, the word $500,000 will mean a very different thing than it means now. What happens to the value of that $500,000 to $1 million home if the tax law changes?
Well, the analysis I've done is to take the entire House bill, and that includes all the things you mentioned, plus the increase in the standard deduction, which reduces the value of the MID, as well as the impact the larger budget deficits would have on interest rates, which matter for the housing market.
Right.
So in that context, with all those moving parts, including the cap on, the 10K cap on property tax and the 500 cap on MID, nationwide, all else being equal, house prices would decline by 3 to 5%. In districts like yours, I don't know yours specifically, but I can guess, in areas like around where I live in suburban Philly, New York, New Jersey, the price declines will be double digit, 10, 12%. Not that I'm a fan of the MID, I'm not. We can talk about how you might want to do this in a better way. It's very costly, and I don't think it's as effective in promoting homeownership as it should be. So I'm not a fan. But I think it is important to recognize that if this plan were adopted, those are the kind of HPI, house price declines you should expect in those. And that's obviously going to be a lot of stress, for those people, for the lenders that made those loans. It's meaningful. The economy will
the federal government that has insured those loans. And if you've got 20% equity and your home goes down 12% in value, and then you have some transactions costs to sell, you're just not going to be able to retire to Wisconsin after you sell your home. And finally, there's this, well, I'll yield back.
The gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Holmgren, for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here. Appreciate your time and your expertise in this important discussion. First, I'd like to address my first question to Dr. Zandy. With respect to the concept of recap and release, you make the point that this might be the most politically feasible option, but I also think there's plenty of agreement that this would have its drawbacks. Can you please speak to the economics of recap and release?
Sure, and I don't think it's politically viable. I think it's, you could argue it might be the least disruptive to the system because you're just basically going back to the future. In a sense, it's no reform at all. So I think there's a couple of very significant problems with it. Most importantly, we're not changing anything. We're going to go back to a too big to fail duopoly that dominates the system. And yes, maybe the GSEs in the future system will be at higher levels of capitalization, regulatory oversight, but you're still left with a system that is very vulnerable to the things that got us into this mess in the first place. So, exactly, why would we do that? Second, these institutions are going to be released into a system they're going to have to capitalize as systemically important because they are too big to fail. They do have costs that, they have agreements with Treasury, and taxpayers paid a lot of money to bail them out, and I think taxpayers deserve some compensation for that. If they have any kind of backstop, they'll have to pay for that. So when you consider all of the costs that they will face as reprivatized institutions, in my view, it will mean that mortgage rates will be higher than they are today. So why would we do this exactly? So in my view, recap and release is a pretty bad idea.
Okay, that's helpful. Let me drill in just a little bit more if I could, Dr. Zandy. your testimony notes, and you kind of referenced this, and I'll quote from your testimony, the GSEs would likely owe the government for the taxpayers' financial support, end quote. Wonder how much you believe they owe to the taxpayers or would owe to the taxpayers?
You know, I don't know the exact number. In fact, that's a matter of significant debate, discussion. It's in the legal system. You know, let me put it this way. I'm an economist. This is at a higher pay grade than I have. I mean, it's a real thorny question. But I would say that taxpayers bail these guys out, and taxpayers should be repaid for that. And the way they bailed out this is an important point. The way they bailed out the Fannie Mae and Freddie Mac was not it's not a loan. This was equity. We took equity in these institutions, and that is at a higher cost. And I think taxpayers should be reimbursed for that cost. What that number is, I'm not sure. Again, it's a thorny question. I don't know. But I think that should be part of the calculation.
That's helpful. Thank you. Mr. Wallison, your testimony points out that the United States is the only developed country with a housing finance system completely dominated by the government. I wonder, why do you think that is? Do you think that they've observed, do you think other countries have observed the lessons of U.S. policies?
I doubt it. I'd like to believe that was true, but I think we really have a case of path dependency here, and that is that the United States began to have a role in housing back in the 1920s, and we continued to grow that system using, for example, the S&L system. When that failed, Fannie Mae and Freddie Mac came up to pick up a lot of their activities. So it's kind of something that has grown in the U.S. system over time. And once that happens, it becomes very difficult to change, right. As I'm sure everyone here is finding, that there are a lot of people who have come to rely on this system, especially those like realtors and home builders who enjoy the fact that housing prices rise as a result of this government involvement. But then again, from time to time, we have these crashes, which we had in 2008 as a result of these government policies. So we really have to look at this whole thing again from the beginning and start talking about whether it makes any sense to have the government involved in the housing finance system. And in my testimony, I've shown that all of the things that we are talking about here, the 30-year fixed-rate loan, lower housing prices, or what we should have is lower housing prices, lower interest rates, helping the people who want to buy first homes, does not occur with a government program. So we should start all over again with a private system which will produce, as the private system always does, the things that the American people want at a price they can afford. And I would point out in my testimony, I show what happens in the auto market, which is also a gigantic market. The prices there have been stable for 40 or 50 years in terms of the median income in the United States. And the reason for that is simply that this is a fully private market where people, consumers, negotiate with the producers. We don't have that in the United States for housing prices because we have the government inserting itself and requiring lower underwriting standards, as a result of which we have much higher housing prices.
My time's expired. I may follow up with some other written questions if that's all right. I yield back. Thank you.
The gentleman's time has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you,
for
Mr. Chairman.
5 minutes.
Mr. Chairman, I was in my office doing very important work until I decided to come over and have some fun. First of all, Mr. Zandi, I appreciate your comments that without a government backstop, the rates really wouldn't change a whole lot. But rates are only one factor in determining monthly expenses. I'm a homeowner, and to be perfectly honest, I own a two-family home because I needed the rent to be able to meet the mortgage when I first bought the home. And for me, and most homeowners, it's how much do I make every month and how much can I afford every month? Monthly payment, not the general, all the other stuff works into it. And if you're going to talk about the rates without a government backstop, we've only had this experience, we haven't had it since the 1930s. Prior to the 1930s, there was a fully private market. There was no government backstop, no government involvement. And the rates were about the same as the rates today, pretty much. But, It was a 50% down payment. 50% down payment. I don't know anybody in any market who has 50% to pay down on a home, and it was a five-year payback period, which effectively takes the average monthly principal and interest and doubles or triples it depending on the math you do. 2.5 times. Tell that to the average American. They love. You can keep your 30-year mortgage if you can get in. And the answer is most of us could never get in. We've done the purely private market before. It didn't work. We're not going back. Period. And those of you who want to go back, I dare you to put it on the floor of the House for a vote. It would be a wonderful debate, and it would be a wonderful result in the next election for those of you who thought that was a good system. I also want to talk quickly about the tax bill that we're all debating, this $1 million number. Okay, sounds like a lot. Well, before I came over, in all of 10 seconds, I looked up average home prices in Boston. And like most Americans, that search brought me to Zillow. Here's what Zillow says the average home price in Boston is: $561,400. Just the city of Boston. That does not include our expensive suburbs. And by the way, Boston is geographically one of the smallest cities in the country. $561,000 average, median. By the way, it sounds like, whoa, gee, that must be a problem. Well, that home price has increased 9.3% in the last 12 months. And it's expected to increase 3.9% more in the next year. That's a pretty good market, the way I look at it, even though it's expensive. And by the way, I also looked it up. As of this very moment, as of right now, there are 428 homes for sale in Boston that are for $1 million or more. 428. I can't afford that. But a $500,000 mortgage is not out of the norm for most people in places like Boston and California and New York and Chicago and many places in Florida and on and on and on. And I just happened to, purely circumstantially, looked up another town, a very comparable, nice town. I've been there, actually. Matter of fact, I did very well. I went there for John Kerry, and they liked me there. I went to this town, and I looked up their average price. Purely circumstantial, I looked up Warsaw, Wisconsin. Well, it's a lovely, it really is a nice town, and they did like me. The average home in Warsaw, Wisconsin is $100,000, 20% of the cost in Boston. Now, I'm sure it's a great home, but that's the difference. The geographics makes a difference, and that home has increased 5.4, half of the increase in Boston. Is expected to increase 2.5%. It's not the same. And the bottom line is, people in Boston make a little bit more, but not that much more.
Would the gentleman yield?
Sure.
I appreciate you bringing up my hometown, but I would note that the $500,000 of mortgage deduction, which is included in the bill, would include then the median income in Boston.
On a median income, but median is made up by people that are over it as well.
But you're advocating
so there
for
are lots of
double the
homes in
median.
Boston that are at $700,000, $800,000, and they're not the expensive homes. For that kind of money, I've always known. I watch HGTV.
Me too.
For the amount of money I can get for any home in Boston, I can get the greatest home in the world in Waco, Texas, according to what they show on HGTV. I'm shocked. You cannot buy a parking space in my district for the amount of money you can get 40 acres in Waco. And that's not good or bad or indifferent. It's not a statement. It's just a fact. And it doesn't make any good things about Boston or bad things about Waco or Warsaw. It just means if we're going to make national policy, it has to be adjusted to regional costs, number one. Number two, and I appreciate the extra time, as far as the 30-year mortgage goes, it's not just one factor. It is multiple factors that lead into the decision that the average American makes, and those factors are totally played against them without a government backstop. Mr. Chairman, I really appreciate the extra time, and I can't wait to get back to Warsaw.
Well, I might differ on you on that point. The chair now recognizes the gentleman from Pennsylvania, Mr. Rolfes, for 5 minutes.
Thank you, Mr. Chairman. Mr. Walson, in your written testimony, you debated the merits and the necessity of the 30-year fixed mortgage. You also discussed the role that the government has in ensuring that this product exists. Does the 30-year fixed-rate jumbo loan mortgage market have a federal backstop?
No.
Why has the jumbo market thrived without a federal backstop?
Because we don't need a federal backstop to have a 30-year fixed-rate mortgage.
Dr. Lee, in your testimony, you compared the housing finance systems in similar developed markets. I was interested to see that Australia, Canada, Denmark, the UK, and the US all have fairly similar home ownership rates despite significant differences in the housing finance systems in each country. We are often told that the 30-year fixed rate mortgage is essential to ensuring that our home ownership rate remains high, yet you point out that, quote, in no other country is the 30-year fixed rate mortgage the dominant instrument. Of course, without the government support that we currently offer, this product likely would not be as ubiquitous as it is today. How important do you think the 30-year fixed-rate mortgage is?
Well, as you can see from the data, and I go beyond the countries that I specifically referenced, is that you don't see this instrument around because it has a lot of interest rate risk associated with it. So you have credit risk and interest rate risk that's inherent in mortgages, and you have to distribute that some way. And other countries have decided that customers can take or be exposed to a bit more interest rate risk, and as a result, you don't need the government backstop in order to ensure that you get sufficient amounts of credit and high rates of home ownership. So the fact that we use and built a system around the 30-year fixed-rate mortgage has by definition almost meant that we have to provide this government support. And I would point out that this didn't work with the savings and loans. We crashed the system back in the 1980s, and we crashed the system again in the mid-2000s. So the question is, do we have to build a system based on the 30-year fixed-rate mortgage? And if that requires government guarantees, you've got a self-fulfilling prophecy.
Mr. Tozer, in your testimony, you wrote, quote, with their protected government advantage status and the powerful economic benefits that accompany it, the GSEs have achieved gains at the cost of crowding out a potentially significant measure of market competition and additional innovation. Assuming that the government-provided advantage to the GSEs were diminished or abolished altogether, what would some of the other impediments to private sector competition be?
Well, again, the issue again gets back to this whole concept is like Dr. Lee said, you have interest rate risk and you have credit risk, and so the big impediment is the concept is that you need the government guarantee to support the interest rate investors who are able to take on the credit interest rate risk, like Mr. Lee said. Banks really can't do it, and the question is, do borrowers continue? You shift it to the borrowers with just a mortgage. And then the concept, can the credit risk be held by the private sector? And that's the big question. So again, the impediment is once you take Fannie and Freddie out of the mix in their duopoly, then the question is you need to make sure that you have access to credit enhancement from all the various issuers that enables them to be able to compete on an even playing field with all the other issuers. So we have a well-functioning market for small to medium-sized lenders.
Congressman, can I make a quick point about the jumbo market? The jumbo market is dominated by large banking institutions. Those banks are systemically labeled, classified as systemically important financial institutions. By definition, they're backstopped by the government. So there is a backstop there. It's not like they're operating in a vacuum without the government back there.
There's no bank out there that's making a jumbo loan?
No, there are, but the market is dominated.
Yeah.
The vast majority of those
Mr. Walson, do you want to comment on that?
Yes, those banks and other banks, not necessarily the too big to fail banks, are also making these loans. And the point is that we studied this market very carefully. We can provide a memorandum on what we found in this market. And in every case where a bank was making a loan since 2014, a mortgage loan, it was lower cost than a GSE loan. What we did was compare the jumbo market to the GSE market, saying just a little bit below the GSE market, a little bit higher than the GSE market for the jumbo loans, and we found that those loans, that when they were being made at a lower interest rate. So it's not necessary to have a government backing of any kind in order to keep the interest rate at a competitive level.
One other quick
point. My time is expired. I'd like to go on, but my time is expired. So
Gentleman's time has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our ranking member, and thank you to our witnesses here today. Before I go into my questions, I'd like to make a few brief statements. But first, I'd like to say to my colleague, Congressman Sherman, next to me, I would like to be included in that 30th Congressional District Codale, along with Duffy and Cleaver. So I just want that entered into the record, Chairman Duffy, that I want to go on the Codale. Now to the witnesses.
Without objection.
Thank you. To the witnesses here, thank you for being here. And certainly while we are here today to talk about sustainable housing finance part 3, I notice that we have certainly not been absent of talking about tax reform. And I was very pleased to see in your written statement, Ms. McCargo, that you address the potential impact of the House Republicans' tax plan and the effect it can have on affordable housing. As a matter of fact, Mr. Chairman, I would like to submit an article for the record from Politico entitled, "Tax Plan Would Cut Affordable Housing Supply by 60%.
Without objection.
Thank you. Let me just take a few seconds of my time to quote from that article. And that article states that builders, local governments, and other housing advocates are rallying against a provision of the House Republican tax plan that would eliminate a key funding source for affordable rentals. As a matter of fact, it says the tax proposal would do away with private activity bonds, which we all know is a growing source of financing for low-cost housing. The cuts would reduce the supply of new affordable rentals by more than 85,000 units a year, or more than 60%, according to an analyst from the Novogradic and Company. One last thing. Private activity bonds are issued by local or state governments and are designed to attract private capital funds to large projects. They have evolved into a common financing mechanism for housing as the supply of low-income housing tax credit, the primary source of financing, and it has been outpaced by the need of low rentals. So with that, in hearing from the articles, can you briefly describe the problem you see with regards to the affordable housing when it comes to the Republicans' tax cut bill? Ms. McCargo, do you want to start?
Certainly, thank you, Congresswoman. The fundamental concerns with the house, even without the tax plan, the affordable housing issue is a significant issue, both on the rental and buy side, on both sides of the issue. The low-income housing tax credit has already seen a lot of pressure going into this, and I think that one of the most important things as a houser thinking about what's happening with the tax plan is that the fundamental decisions that are made, whether it's the mortgage interest deduction, low-income housing tax credits, or other plans, is that we are continuously looking at how we can put money that is taken from one part of the plan back into housing. One of the concerns in particular is that for example, the mortgage interest deduction, if we're looking to really spur home ownership and move that forward, we might want to look at how we might be able to take what is, if that was to be reduced, those dollars, and how do you put those back into housing in the form of a tax credit, for example. So I just think affordability is a critical issue, whether you're renting a home or owning a home across the nation today, and that the tax plan and the decisions that are made to make cuts or any revisions that affect housing need to be thought about in terms of how do we make sure that we're enabling affordable housing and finance.
Thank you. My time's about to run out, but I would like to make a brief comment. As we talked about earlier when you asked the question of what's middle class, we all know the numbers that we're given, but I think it's important to state it depends on where you live. If you take my district, I have the entire city of Bexley, and we have $10 million homes there and $2 million homes. And some of those individuals would probably call themselves middle class that own $1 million home. So I think to Mr. Sherman's point, it definitely depends on where you live. But also, I was elected to represent rich people and poor people. So I don't think you can make it an either or say to her that it's unfair if people want a tax deduction on $1 million or $2 million house. So I think we have to figure out how to do both, not to take away those things for those who are less than middle class, but not to punish others. My time is
Lady's
up.
time has expired. The chair now recognizes the gentleman from North Carolina, Mr. Budd, for 5 minutes.
Thank you, Mr. Chairman. I'm also interested in Mr. Sherman's Codell, California. My only fear is that I would check in but never leave. So, Dr. Lee, in your testimony, you noted that Canada has a government guarantee, correct? Right? So what percentage of the Canadian mortgage market is covered by this guarantee?
The Canadian system is similar or pretty much modeled after the FHA-Ginnie Mae combination. So in Canada, all loans over 80% loan-to-value ratio have to be insured, regardless of whether they're held by banks or by in a securitized form. So the CMHC is providing most of that mortgage insurance, and I think roughly about 50% of all mortgages have government mortgage insurance. The second element of that is like Ginnie Mae, is they provide a timely payment guarantee on securities, mortgage-backed securities that are issued, and the market share there is about 31%.
So that's a separate guarantee, the timely payment guarantee?
Correct. It's a layered guarantee. So you might, if you hold the loan in portfolio, you don't have that second guarantee. But if you sell the loan, then they put that timely payment guarantee on that.
So by contrast, about what percentage of the U.S. market is guaranteed by Ginnie, Fannie, and Freddie?
61% is the number there. That's the combination.
Okay.
I'm sorry, no, it's 65%. It's 31% in Canada, 65%. And in looking around the rest of the world, there's no other country that has more than 10% of loans securitized, and almost all of those are private label. You don't see government guarantees in most other countries.
So what are the credit characteristics of the loans that are covered by the Canadian government? For instance, what's the down payment requirement or the debt-to-income ratio of the borrowers? And you did mention an 80% number earlier, but if you would describe those requirements.
Right. So after the crisis, they used to have 95% loan-to-value ratio maximums. They lowered that to 90% for purchase loans and 80% for refinance loans. They've since relaxed that a little bit, and for loans under $500,000, you can go back to 95% there. Importantly, loans are recourse in Canada, so that also provides a significant deterrent against mortgage default.
So is there a limit on the amount of loan that is covered under Canada's guarantee?
Yes, there is, and that was actually lowered after the crisis. I'm trying to remember what the maximum is. There is a maximum cap. I think it's maybe something like 400,000 or so, but I'd have to actually check that. I don't remember off the top of my head.
About 400,000 then. So does Canada have a conforming loan limit?
No, because they don't distinguish between government and non-government loans.
Okay. And how about any limits on borrower income eligibility?
They also have that, and the most recent numbers, I think they will allow that to go up to 45%.
Okay. Very good. Thank you, Dr. Lee. Mr. Chairman, I yield back.
I think it's important to point out that they're willing to move those standards up and down on a regular basis. So, unlike here, once we make a change, we generally don't change it. They are moving those thresholds all the time. It's a macroprudential tool they use.
Very good. Noted. Thank you.
The gentleman yields back. The chair now recognizes the gentleman from.
Thank you, Mr. Chairman. Well, we have a very distinguished.
So the gentleman from California, Mr. Royce, for 5 minutes.
Thank you very much, Chairman. You put together a very distinguished panel here of witnesses today. And I wanted to ask Mr. Tozer, given your past experience, and this is an issue that we've spoken about at LA at the Milken Institute out there, but given your expertise, again, if we wanted to explore what the risk transfer deals at Fannie and Freddie and NFIP have taught us thus far, if we look at risk transfer, we've had some deals through the bond and reinsurance market. My understanding is that they could be doing a lot more than they're doing already. Gwen Moore and I have legislation to encourage them to do that. In addition, I've recently been briefed that in light of the damage caused by the hurricanes, the contracts that the NFIP purchased will pay $1 billion of reinsurance, and that would return to the taxpayers 85 cents on the dollar as a consequence of those reinsurance contracts. So, given these and other examples, is there any reason why the federal government as an entity should not seek to maximize the transfer of credit risk and the transfer of insurance risk and other taxpayer exposures to the capital markets and reinsurance markets when practical?
I agree. I think you should excuse me, transfer as much of the expected credit loss as you can. I mean, the question you run into is diminishing returns. Like, for example, most analysis I've seen shows that really, if you, for example, transfer the 40% of the loan amount, like, for example, you have a $100,000 loan and you transfer $40,000 of risk to a third party, you're going to cover 99.9% of the chance of ever piercing that. So the question we run into is, when does the cost become prohibitive? It's like buying too much insurance.
Well, I understand the concept, but let me ask you, are we currently approaching, in your opinion, the point where...
Well, the thing I think we need to realize is with the GSEs, and when they have a loan that has private mortgage insurance, they're insured down to 65% exposure right there. The borrower's paying to get them to 65%. So the big area that they're concerned about is the power loan puts down 20%. So I think the concern is making sure the loans that only have a 20% down payment are credit enhanced up to at least a 65 or 60% area. The loans that carry private mortgage insurance are probably pretty close to being what they need to be at because they're at 65%. But I think you need to look at this whole concept, what's the tipping point of the cost versus the benefit to the taxpayer, and then also to the question also, Fannie and Freddie's capital should be also, or if you have an issuer in the future, that should also be there to protect against the government. So the question becomes between all those layers, I think the question is the government should make sure that all the losses are absorbed by the private sector.
Right. And in your testimony, you state that many have cited deficiencies and weaknesses in PLS contracts, governance, structures, and collateral as a leading cause of many billions of dollars of misallocated losses. These misallocated losses spurred a crisis of confidence and the resultant trust gap on the part of the institutional investors who bore them. So we heard similar concerns at our hearings last week, right?
Right.
My question is a straightforward one here to you. What reforms could we make to help repair the trust gap and reignite the PLS market here?
Well, the key, I think, is we have to have an active master servicer. Because what's happened is, for example, in the Ginnie Mae world, if an issuer hires a servicer, they're on the hook for the losses. So they're going to keep them to make sure there's no misallocation. If a servicer messes up, they pay the losses. The same thing, Fannie and Freddie act as a master servicer to make sure the servicers, if they mess up, they lose. In the private liberal securities, it was kind of like trust me. The servicers got it to kind of control the henhouse. So the key thing is having a layer of someone there to do the oversight over the servicers to make sure that if they make a mistake that causes losses, that those losses are absorbed by the servicer and not passed on to institutional investors by making stronger contracts, but also having a organization that actually has the teeth to enforce those contracts versus letting the servicers kind of police themselves.
Anything else that could reignite the PLS market?
Well, the PLS market in general, I think, is going to be, it's always going to be relatively small because, not so much because of the credit side. I think there is tremendous appetite for credit investors. The problem is interest rate investors want the homogeneity of being able to have a government-backed security that they can trade large amounts in the TB market. So I think the concept is, I think the PLS market, as far as the credit side, through the CRTs, I think it's critical to develop because as we can move to the point where more and more credit transfer is occurring, especially if we get to the point where we have more and more issuers, like we talked about in the Milken proposal, we need to have a good working private sector credit transfer process. And I think that's what we need to make sure we have in place.
The gentleman's time has expired. The chair now recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Thank the ranking member as well. Thank the witnesses for appearing today. Please permit me to ask a question that was a burning question some time ago. Was the CRA the cause of the 2008 downturn? If you believe that it was, the CRA created the 2008 economic debacle, would you kindly extend a hand into the air? Thank you. Now do this for me, and I want you to be as terse as possible, but this is really important. I need for the record to reflect just who you are. So if you would, let's start to my far left and just give your name and the company that you represent. Would you do so, please, sir, at my far left? Your name and the company you represent.
My name is Peter Wallison, and I'm appearing for myself. I am an employee, however, of the American Enterprise Institute.
Thank you, sir. Next, please.
Yeah, I represent myself, but I am the chief economist of Moody's Analytics, a division of the Moody's Corp. I am on the board of directors of MGIC, one of the nation's largest private mortgage insurers, and I'm also soon to be the chair of the board of Reinvestment Fund, which is a CDFI headquartered in Philadelphia that does affordable lending.
Thank you, sir.
I'm Michael Lee. I'm a self-employed consultant in San Diego, California.
Thank you, sir. And ma'am?
Elena McCargo. I'm representing myself, and I work for the Urban Institute and as the Housing Finance Policy Center co-director.
Thank you, sir.
I'm Ted Tozer, and I'm a senior fellow at the Milken Institute, and basically representing myself as my background, as well as the Milken Institute.
Thank you. This has been a concern that the committee has had to address, and I just marvel at how we have gone from the CRA being the genesis of the crisis, and we really did have that debate in this committee. I remember Mr. Frank talking to Ranking Member Cleaver and I about this. And if you recall, Mr. Cleaver, we went to the floor because there was the widespread belief that it was the CRA that caused the economic downturn. And this is going to be a benefit to me as I go forward, dear friends. I just want to cite that it's Tuesday, November 7th, 11:43 a.m. All of these noted experts, persons who have some degree of knowledge in this area, have indicated to us that it was not the CRA. Now, let's move on to something else before I come back to CRA. The jumbos, Mr. Zandi, you wanted to say more about the jumbos, and you didn't get the opportunity to. I'd like for you to, if you would, to be as pithy as you can, but please speak on it.
Yeah, I think the other point about the jumbo market is that it's to very high-quality borrowers with very high credit scores, low loan-to-value ratios, low DTIs. So that isn't the market we're talking about here when we talk about housing finance reform. So it's a very, very different market.
And you also mentioned that there is a backstop for it. While it may not be direct, there is an indirect backstop. Would you comment on that, please?
I'd say it's very direct. I mean, these are systemically important financial institutions that dominate this market, and they have a backstop. And I would also point out, in the case of Canada and most other countries across the world, the lending is done by large, systemically important institutions, and there's no debate about it, and they have a government backstop. So the system is backstopped by the government explicitly.
but it's not a mortgage-specific backstop. So banks are diversified, and aren't concentrated just in mortgages. What differs in the U.S. is we do that for mortgage-specific institutions.
Thank you. Let's move to one other area quickly. Is there anyone who believes that there should be absolutely no government involvement at all? Remove the government completely, no backstop, nowhere involved in this process at all? If so, would you kindly extend the hand in the air? I believe there's at least one. All right, sir, I appreciate your comment. Would you tell me, Mr. Zandi, why you're of the opinion that there has to be some backstop, some government backstop?
I think if we want long-term, fixed-rate, prepayable mortgages to be the mainstay of our system, 30-year fixed-rate, 15-year fixed-rate loans, we need a catastrophic government backstop. It has to be explicit, and it has to be paid for. The borrowers have to pay for it. And that's a very doable thing, and we should do it, because that is the system that we believe is the appropriate one and that provides the best service to the American citizen.
Thank you very much. I'll put it to be continued, Mr. Chairman, on the CRA.
The gentleman yields back. The committee is now going to go into a second round of questions, but we are not going to do 5-minute questions. We are going to do 2-minute questions. The chair now recognizes the gentleman from Pennsylvania, Mr. Rolfes, for 2 minutes.
Thank you, Mr. Chairman. I'm just enjoying this hearing, really, and hearing from all of you, and thank you for being here. Mr. Zandi, I just want to go back. We talked a little bit about this concept of a catastrophic backstop. Can we quantify that in any way?
Yeah, I think the system, the entire financial system, is now coalescing around a capital standard for private capital that takes the first 5% of loss. After that, that would be considered catastrophic. Just to put that in context.
5% of loss of what? How would that play out?
Yeah, just to give you context. In the Great Recession financial crisis, the Fannie Mae and Freddie Mac had total realized losses of not quite 3%. And you have to recognize that prior to the crisis, there was no QM rule. There was no governor on the kinds of underwriting they were doing. Post-crisis, we now have this governor, and so the quality of the loans that they are able to purchase and to insure is measurably higher. So even under the Great Recession scenario where unemployment would get to 10%, house prices would decline to 30%, the stress tests that they're being required, all banks and financial institutions, including the Fannie Mae and Freddie Mac, are being required to engage in, the losses would be measurably lower than that. Probably, if you did the arithmetic, 1.5% to 2%.
Yeah,
so 5% is a lot of capital.
I might want to follow up with you on a question, just again, getting some parameters.
That's it. 5% is, after that, it's catastrophic. That is what you would.
The question I'll follow up with in a written form is like 5% of what? That's what I'm.
That is the number of loans at default. Okay. Times the loss that would be incurred because of that default. That's the total loss.
If I could real quick go to Mr. Wallace. In your testimony, you explained how reduced underwriting standards can actually make housing less affordable. You described our existing affordable housing policies as leading to, quote, higher leverage, a lower home ownership rate, and reduced affordability. And I would guess higher home prices too?
Yes, in fact, that's the whole problem.
And I just, Ms. McCargo, I mean, can you respond? Because it makes sense to me what Mr. Walson is saying, that all these policies have really driven up the cost of housing, which makes it's an affordability issue, is it not?
So we definitely have an affordability issue. I just cannot find the way to express that I don't think that issue comes from the 30-year fixed-rate mortgage or from the
I don't think he's saying that.
Yeah, or from the government guarantee or the government's involvement in this process. Going back to 2008, if you look at the lending that was going on before 2008, leading up to the crisis, and you look at the people, the private label investors that were in the market at that time, and you look at the performance on the loans that were made prior to that period, so I'll just say 2005, 6, and 7, and loans made prior to that period where you had a huge proliferation of risky products that were not 30-year mortgages.
But weren't Fannie and Freddie securitizing Altays and subprime loans too?
They were some. They were not all. There was a huge market called the private label securitization market that was a big market and had much more share at the time than Fannie or Freddie did. And they were holding those loans. And when that When 2008 happened, those players disappeared from the market.
The portfolio of Fannie and Freddie's paper, significant percentage of Alt-A and subprime, no?
There was a percentage of it, and there was, but it was.
My time's way over expired, but Mr. Chairman, thank you. I'm going to yield back.
The gentleman yields back. I'm going to change the rules midstream. We're going to do 3 minutes because you did take 3 minutes. So the gentleman from Missouri, Mr. Cleaver, is recognized for 3 minutes.
Thank you. Ms. McCabe, again, thank you for being here. The McKinsey Global Institute put out a study recently which says that by 2025, we'll have about 1.6 billion people globally living in homes that are either unsafe and decrepit or housing that is unaffordable that would be available. Do you have any suggestions on ways in which this committee and the U.S. federal government can help create the atmosphere for a larger stock of affordable housing?
Thank you. The affordable housing issues have exploded since the crisis. We've seen a lower vacancy, less construction in the affordable space, a lot of constraint on builders. A regulator and the cost to build and construct housing is incredibly high. And that makes the building and the ability to create affordable housing stock very, very difficult. One of the key things, and I'm just going to go back to the GSEs for a moment, I think that is a good move, is the duty to serve rule that is requiring that the GSEs look at the preservation of affordable housing as part of how can they have more of a footprint and an impact on preservation of affordable housing. Most affordable housing stock in America is old, and it needs to be preserved, it needs to be renovated, and there needs to be investment made there such that folks can afford to get into those homes and we can have more stock brought to the marketplace. So I do believe we have a credit crisis on one side where people are having trouble getting into housing. Once this Congress fixes that problem, we then have a serious problem of there's not going to be enough housing stock available for people to buy or rent at this point in time, given the direction.
Well, one of the problems when we're talking about rehabilitating housing, which I agree with, I mean, we've done enough demolition, but the cost is going to exceed the value of the home or the property, and so. You know, you get criticized by giving a loan on a property that, you know, is not valued at the level of the money that went into it to rehab it. I mean, it's a conundrum that many urban areas are facing, and if any of you have any ideas on how to solve that problem, it would be helpful. Yes.
Just one more thing on affordability. Again, I'll go back to duty to serve and the focus that has been put on manufactured housing, modular housing, and different types of affordable housing stock. I do think the opportunity to think about better financing structures to support those types of affordable housing opportunities is something that, again, the GSEs are looking at and exploring, and I do think that is another space where in housing finance reform and what the GSEs are doing in housing policy, there could be help for finding more ways to get at that type of affordable housing as well.
Thank you.
The gentleman yields back. The chair now recognizes himself for 3 minutes. Mr. Zandy, you've said several times, I believe, that you believe that the borrower should pay for their guarantee. Is that correct?
Correct.
How do you set the guarantee? How do we know that we're collecting enough money to actually, you know, have enough resources for that guarantee? I think that becomes that's $1 million question. I don't know, and I haven't got a good answer.
Yeah, it's a great question. I don't think there's a good answer. I set it high enough that I feel very comfortable I'm collecting enough money and building a mortgage. I'd set up a mortgage insurance fund, just like a deposit insurance
the FDIC fund of some sort.
And put the money in there and keep building it, and I wouldn't stop. You know, you can do the arithmetic. Go back to the multiple guarantor system and put
People
a 10 basis point fee.
People here like to raid those kind of funds.
Pardon me?
People here like to raid those kind of
funds. No,
funds.
you can't raid the diff. You can't raid the diff, so don't raid. You can't just design it exactly the same way so you can't raid the MIF. It's there to backstop that system if it ever gets in trouble, and just let it build. And it will. It'll build. I mean, if you put a 10 basis point fee on every mortgage that is insured by the future guarantors that take over for Fannie and Freddie, that will raise a boatload of money, and we'll be fine. We'll be fine. Very conservative.
Mr. Wilson, do you agree with that? I know you're throwing all these policies to the side, I know, but
well,
on that?
I mean, the private system would work anyway, but just talking about mortgage insurance, the FHFA has required that all mortgage-backed securities be backed by mortgage insurance, and has required the mortgage insurance industry to have sufficient tangible assets behind its insurance. So it would be the private system that would set mortgage insurance premiums. The problem with that, of course, and Mr. Zandi didn't address it, is that very risky mortgages with low down payments, with low FICO scores, et cetera, are going to be very expensive under any system where you have a private mortgage insurance.
And therefore, should you have a one-size-fits-all, or do we have to have a guarantee fee that meets the risk of the mortgage? Is that your position, Mr. Zandi?
For the catastrophic backstop, no, I wouldn't do that. I mean, I think
one-size-fits-all.
Yeah, and what I would do, the other thing I would do, though, is I would have a clawback ability so that if you ever got into the myth and you blew away the myth, and I can't even imagine that scenario, but who could imagine Great Recession, then you have the ability to claw that back with higher fees in the future to future borrowers in that system.
I only have 30 seconds left, and Ms. McCargo, I want to chat with you later. We have a housing issue in rural America that's very challenging for us that we aren't able to get our hands around. I'm concerned we only focus on urban America, and we kind of, because we're all sparsely populated, we don't get the same resources and effort, and it's just as devastating for our communities. I'm sorry that we had a conversation on taxes today, but we've seen tax policy and housing policy intersect, especially in the conversation of the day. I would just say this, I think when we use economic warfare and talking points, but then we accommodate the talking point with tax policy, all of a sudden we see people get really squeamish, and we start saying that million-dollar homes are for poor people or middle-income people, and it's a head-scratcher for me. Maybe we're better off not playing that economic warfare and go, what's the best policy? Let's stop bludgeoning each other, because when you bludgeon each other, you might not get the best policy, and when you see that policy accommodates rhetoric, it doesn't end up being the best policy. With that, my time has expired, and the chair now recognizes the gentleman from California, Mr. Sherman, for 3 minutes.
Mr. Chairman, I wish not to bludgeon you, but to invite you to Southern California for critically important committee business in January or February.
I've already agreed to come. I'm there.
Yes. Ms. McCargo, you're absolutely right. We need to build more housing. In my area, that may be the problem may be local government and land use planning as much as anything else. We're told that we ought to blame Fannie and Freddie and the federal guarantee. I would say that perhaps Fannie and Freddie are so pernicious that they caused the meltdown in 2008, 2009 in Iceland, Ireland, the United Kingdom, and Denmark. And that they have a pernicious effect on home affordability so great that they have made homes unaffordable in London, Tokyo, and Vancouver. The one thing that, so we have meltdowns, other places have meltdowns. We have some areas with high home prices that are difficult for people to afford, so do other places. What's unique to the United States is that we have the 30-year fixed rate, prepayable, non-recourse loan at very often with a 10% down payment, and people whose parents can't afford to help them can still buy a home. Mr. Zandi, the takeaway for me at this hearing is double-digit loss of value of homes in my district.
If you give me your address, no, only kidding. In fact, I'll send you, if you're interested, a worksheet that shows by county the HPI decline I would expect, at the peak HPI decline I would expect as a result of the bill.
Yes, I need that.
I'll give that to you.
I look forward to getting that from you and to sharing it with my colleagues from the variety of counties in California. We have now, Mr. Tozer, is We have the GSEs. They have seller servicing guidelines. They both have underwriting standards. There's not a race to the bottom in the underwriting standards. You can't have one guarantor cutting its underwriting standards to gain marketing share. One could imagine that if there were a different system, that there would be a race to the bottom, and then many of the mortgages wouldn't have title insurance, wouldn't have insurance to say that it is indeed a first priority lien. What are the ways we can prevent a race to the bottom in terms of lien quality if we have more than two guarantors or securitizers?
Well, the key is that you need to make sure that the guarantors transfer the credit risk to a third party, because that way that third party will kind of play policeman to make sure that you don't get out of control. Like, I think the best place to start is the private mortgage insurance companies, because they're taking on all the credit risk now. Even on your standards you mentioned, if you don't put 20% down, the PMI companies take on the credit risk. So I think they're the good policemen that kind of put a floor in there, because they're on the hook for the losses. And then when it comes to the issues of title insurance, it gets back to the point again that the guarantors have to take on the catastrophic credit risk, because if the title insurances aren't there, it affects them. The government only steps in when they completely fail, because it's a huge incentive to be viable financially before the government steps in for you to be not to race to the bottom, because the government's not going to bail you out.
I believe my time has expired.
The gentleman's time has expired. The chair now recognizes the gentleman from Texas, Mr. Green, for 3 minutes to talk more about CRA.
Yes, the CRA and other things. Let's start with the other things quickly. Is there anyone who believes that there won't be a government backstop, regardless of the plan, if we find that the economy is about to go under? I don't believe in government backstops. I'd rather not have one. It's better to plan one than to have to develop one when you find the economy about to go under, as we had to do after 2008 and 2009. Seems like we ought to look at having an orderly process as opposed to something that we have to do on the fly. I remember when the secretary came in and explained to us that we were about to have a crisis unlike we'd seen in our lifetimes, a good many of us. So I don't want a government backstop. I just don't know that there's any other choice, because we want our economy to continue. And we could have refused to bail out the banks, as we say it, but the results would have been catastrophic. Is there anybody who thinks that it wouldn't have been catastrophic? Raise your hand, please. You don't think that it would have been catastrophic? I'm going to give you 10 seconds on that, maybe 20. Go ahead.
No, I'll just say it wouldn't have been catastrophic. We caused that problem.
But let's talk about the point where the problem had to be dealt with. If we had not bailed them out, what would have happened?
Probably nothing. Because
probably nothing?
Probably
when
nothing.
Banks wouldn't lend to each other?
The banks were lending to each other by the time.
By the time of when we got involved, the banks were not lending to each other.
That's not correct.
It is correct. Mrs. Zandy, would you give your commentary?
Yeah, it had been catastrophic. The system, the system was shutting down. The commercial paper market wasn't working. Large non-financial corporates that couldn't get funding. We were on the verge of a complete meltdown. We lost. Remember back. January of 2009, we lost over 1 million jobs. In my book, that's catastrophic. And it would have been much, much worse if we had not stepped in aggressively through the TARP. Yeah, no one likes bailing out big banks or banks in general. But we absolutely had to do it.
Yes. Let's go to Mr. Tozer. Sir, would it have been catastrophic?
Yes, it would have. I mean, I was a mortgage banker back then. And for just put an example, I had a mortgage trade on where I'd sold Ginnie Mae or Fannie Mae security to Goldman Sachs, and I'd bought one from Morgan Stanley, and they wouldn't even take trades from each other. Normally, I would sign the trades. They wouldn't let me sign
I hate
the trades.
to interrupt you, but I have to say this. This is the problem that we run into. We run into this problem of persons who still believe that the CRA caused the crisis and that if we had done, you're not one of them, sir. No, Mr. Williamson, is your name Wallison? You're not one of them. But there are those who do believe this. And this is a part of the problem that we have in resolving the crisis that will come forward at some point in the future, trying to find a way to get beyond some of these fallacious arguments that dealt with the crisis that we had to encounter. Look, thank you, Mr. Chairman. I've gone beyond my time. And I'll yield to you time to respond.
You have no time left to yield, but I appreciate that.
I'll yield the time I don't have to you.
But I thank the gentleman for yielding back. I want to thank our witnesses for their testimony today. I would just note that this is, as we can see, a complicated and involved process. I look forward to, and I think the committee does, to have more in-depth and longer conversations with all of you to make sure we get it right. Thank you for taking the time today and providing your insight and expertise to the committee. Without objection, all members will have 5 legislative days within which to submit extraneous materials, additional materials to the chair. If you have questions, we will then submit them to the panel. Hopefully, the panel will respond in a prompt and timely manner should you get questions from the committee. With that and without objection, our hearing is now adjourned.